안녕하세요. 한경 글로벌 마켓 애청자 여러분 반갑습니다. 세계 시장, 세계 경제가 굉장히 시끄럽습니다. 미국의 경기 침체가 온다는 얘기부터 엔캐리 트레이드의 청산 이런 것들이 굉장히 세계 시장을 높여놨다가 낮췄다가 지금 굉장히 어지러운 그런 상황인데요. BCA 리서치의 리티카 만카 글로벌 전략가를 모셔서 현재 세계 상황에 대해서 물어보겠습니다. 이분은 인도에 계신 분인데요. 최근에 급등해서 지난달까지 사상 최고가 기록을 갈아치운 인도 시장에 대해서도 여러 가지 질문을 해보려고 합니다. First question, do you still expect a recession in the US economy within the next 12 months? What are the reasons behind your forecast?
So at the Global Investment Strategy Service at BCA Research, we've held one view for a fairly long period of time, and this is since 2023, in fact, which is that we have been making the point that we expect a recession to arrive in the US either by late 2024 or early 2025. So that's a view we've held for quite a bit of time, and we continue to hold at this point in time. The reason why we think that a recession is very likely to occur in the United States is mainly because of three reasons. First and foremost, I'd say that we are firmly of the opinion that the unemployment rate in the US is going to rise meaningfully. We're literally on the cusp of a meaningful increase in the unemployment rate in the US. Number two, the US consumer, which has been the protagonist of everything that's happened in the US economy over the last year. The US consumer isn't in the fine health he or she is made out to be. And that's our second concern. And last but not the least, the only other engine of growth, which is investments, both residential and non residential investments, we worry are not in a shape to fire growth any further or support growth any further. So I'd say that's why we remain convinced that a recession is around the corner for the US economy, and those are our reasons.
Even if the Fed take aggressive measures such as 50 bips rate cut in September and November, do you believe these measures will not be sufficient to avert a recession?
I'll start by saying that in a base case, we are expecting the Fed to administer a 50 bips rate cut in September and then follow it up with two more rate cuts later this year. So, despite that expectation of rate cuts beginning this year and three rate cuts being administered this year, we don't think that's going to be in to prevent a recession from arriving in the US economy. And the reason for that is fairly simple. The reason for that is the fact that monetary policy in the US, or actually any other country, works in loops and lags. It almost never operates contemporaneously. And this time around in the US, there are certain institutional reasons there are certain structural reasons as to why there will be a lag between the Fed cutting rates and that translating into lower borrowing costs in the US economy. I'll illustrate this point to you with the example of mortgage loans. Remember, today the 30-year mortgage rate is fairly high, but the effective interest rate facing mortgage borrowers is fairly low. The reason why that wedge has opened up between those two rates is because post GFC, the percentage of fixed interest rate based mortgages in the US went up pretty substantially. And that's why a large number of borrowers were actually shielded from the monetary policy hikes that the Fed pushed through. Because of this, now that the Fed starts cutting rates, it won't contemporaneously translate into rate cuts or lower borrowing costs for borrowers, because as these fixed rate mortgages come up for renewal, these borrowers will have to deal with higher rates. So, very simply put, monetary policy operates in loops and lags, and which is why, despite those rate cuts that we do expect from the Fed, we don't expect the early phases of those rate cuts being accompanied by a reduction in borrowing rates in the economy.
And that means you think the Fed make a mistake already, right?
I mean, I wouldn't say it's a mistake that the Fed is making. The Fed's primary mandate is to look after inflation. Its secondary mandate is to look after growth. So, unfortunately, it doesn't have the degrees of freedom it needs to administer aggressive rate cuts until that unemployment rate starts zooming up. And given that, it'll take a little bit of time for that unemployment rate to start zooming up. It is completely fair as to what the Fed does, which is initially gingerly cuts rates, but once it starts seeing that growth is under duress, it then starts aggressively cutting rates.
In the light of current economic uncertainties, do you believe that investing in gold remains a still good strategy?
I'd say from a tactical perspective, from a 1 to 3 month time horizon perspective, we are actually constructive on gold. But if you look at things from a 6 to 12 perspective, we're not so constructive on gold. We think that gold prices will be in a sort of range bound or neutral territory. Why do we expect gold prices to continue their march upwards in the near term? I think a couple of reasons there. Firstly, once the Fed starts cutting rates and the market builds that into its expectations, that lowers the real interest rate in the economy, which is good news for gold. Number two, in the near term, I do think the dollar will depreciate, which is again good for gold. And thirdly, and fairly importantly, gold has momentum on its side. So, gold has been one of the few asset classes that have given you decent positive returns in the midst of all this market mayhem. So, I think that's the reason why, from a 1 to 3 month perspective, we are on gold. But if you look at things then from a 6 to 12 month perspective, I think that momentum will fade. And the reason why gold might not do well from a 6 to 12 month perspective, even though we are expecting a recession to arrive in the US, is simply because when you look at historical crises, if you look at historical recessions, you can see that there are several recessionary episodes. Gold initially rallies, but then eventually is a significant correction. That makes a lot of sense because remember, when a recession arrives and all asset classes are delivering negative returns, investors are likely to even sell their winners. So I think that's one factor which will impede gold prices performance from a 6 to 12 month perspective. The other factor will be, central bank gold purchases. Remember, one of the big reasons why gold prices have done so well of late is because central banks, in India, in China, in Turkey, are buying gold in a very big way. We think that dynamic could come under pressure from a 6 to 12 month perspective if gold prices keep going up, because at the end of the day, even central banks can be price sensitive. So that's how we think gold prices will pan out in the near term and in the slightly longer term.
Oh, thank you. Great answer. With the recent declines in the bond yield, do you still consider bond to be the attractive options? What is your forecast for the 10-year US Treasury yield by end of this year?
I'd say you're right. The US 10-year yield has corrected, has moved downwards quite a bit. Last I checked my Bloomberg screen before getting on this call, it was at 9%, which is a substantial reduction from where we were in April this year. Even though we've had that downward movement, we do think that there is more downward movement to come. Like I was telling you earlier, my own sense is that the Fed will be cutting rates gingerly in 2024 and then more aggressively in 2025. And my own sense is that there is a good chance that the federal funds rate goes down to as low as 2% by late
2%.
2025. That's right. That's a pretty low number. So 2% is where it could end up at. And if that does happen, it essentially means that the US 10-year yield could go to something like 3%. So that's the reason why we're still constructive. We're still overweight on bonds from a global asset allocation perspective, and we are underweight on equities from a global asset allocation perspective. And worth highlighting that we made this switch in June itself. We're not responding to what's happened to the market and then going ahead and saying that what, we're actually underweight equities. I'm happy to report that the Global Investment Strategy Service at BCA turned underweight on equities in June itself.
You said you expecting federal fund rate around 2% if the recession comes. That means your forecasting recession is very severe, right? Not all technical things.
Over the last 2 decades, in global markets, we've seen three types of recessions. Recession number one is the technical variety. Recession number two is a meaningful recession, but not something that lasts for too long. I'd say the 2000 or the 2001 recession is a good example of that second variety of recessions. And the third variety is, of course, what we saw in the aftermath of the global financial crisis, a long, deep, painful recession. I'd say our own expectation at this point in time is that in a base, the recession that does show itself this year is going to be of the second variety. So not as shallow as a technical recession, which doesn't affect financial markets, risky assets that much. At the same time, not as severe as, say, the 2008-9 episode, where you're just taking so much time to get the economy back up on its feet, but something that's comparable to, say, the recession that followed after the dot-com bubble burst, which is, you do see a meaningful correction in risky assets. You do see the Fed cutting rates. But the cutting of the rates translates into the US economy getting back up on its feet relatively soon, as compared to, say, the 2008-9 episode.
What are your projections for the US dollars value through the end of this year? How do you see the yen-dollar exchange rate evolving?
Right. So you're probably closer to the action when it comes to how the yen is moving. But I'll quickly highlight to you our views. So with respect to the US dollar, from a tactical perspective, we do expect the USD to depreciate on a 1 to 3 month horizon. The reason for that is mainly because, like we were discussing earlier, we do expect the yield in the US to move downwards. And since yield differentials will move against the USD, this will translate into a depreciation of the USD against major world currencies. However, from a 6 to 12-month perspective, things could be different. We expect the US dollar to stop depreciating, enter a neutral to slight appreciationary space. The reason for that is obviously because we're expecting a recession to arrive in the US. History suggests that the USD, by virtue of being a defensive currency, tends to rally when a recession arrives. But given that the kind of recession that we're expecting is not going to be, in a base case, a very deep and very long one, we're not expecting a massive appreciation in the USD, but a small appreciation or a neutral-ish movement for the USD. So that's our expectation on the USD. With respect to the yen, I think worth highlighting that we've been making the point for quite some time that the yen will be the currency of 2025. The reason why we've been saying that is simply because we'd made the point that you actually don't need the Bank of Japan to do anything for the yen to appreciate in a big way. And that's because if the recession arrives, which is what our base case is, every central bank around the world will be cutting rates. The Fed, the Bank of England, the ECB, the Bank of Canada. The Japanese central bank would like to cut rates, but won't be able to cut rates meaningfully because it didn't hike rates in a big way in the first place. And that sets up the yen quite nicely for a massive appreciation because yield differentials, even without the BOJ doing anything, start moving in favor of the yen. So I think we're big yen bulls. And our own sense is that the yen could go up to as much as 115 as the events. That's right. So with a 115, not 150, that's where we think the yen could head to as that recession plays out, as central banks around the world cut rates. And the BOJ actually, even without doing anything, has to see its currency appreciate.
If yen moves to the 115, the unwinding of the yen carry trade will be fortified. And do you see the unwinding of yen carry trade continuing? Will this unwinding continue to negatively impact the global financial markets?
I think there's no two ways about the fact that the yen carry trade will have to unwind. And I think, certain events over the last few weeks have caused that to play out very clearly. On one hand, the BOJ administered that rate hike. And on the other hand, we all saw bad growth data, which basically caused the market to pull forward its expectations around central bank rate cuts. So that combination was really responsible for yen carry trades being unwound the way they have been unwound. Going forward, I think that dynamic will continue. But I'll make an important point here, which is that the proximate reason for global financial markets, particularly equity markets, seeing a correction, will not be the unwinding of the yen carry trade. But to our minds, the more proximate reason will be the fact that markets realize that AI linked stocks in the US are perhaps quite overvalued. And markets realize that the global economy is under a degree of duress from the perspective of growth. So I'd say those will be the proximate reasons which drive a correction in equity markets. And the yen carry trade will, of course, continue unwinding, but I won't say that's the primary reason why markets will see a continued correction in the value of risky assets.
I would like to ask you about the Indian stock markets. The Sensex index hit an all-time high last month. Is this a good time to invest in the Indian market? What are the primary risks investors should be aware of when investing in Indian market?
To answer your question, I'd say that at this point in time, our main worry with respect to India is its rich valuations. While I say that, I also want to make the point that historically it is worth noting that rich valuations were not a necessary condition for India to underperform. You've actually seen several episodes in the past where India is super richly valued as compared to, say, China, and it continues to get richer and richer valuations. So that's worth bearing in mind. But today, the overvaluation in India seems a bit too much. India is trading at about a 95 to 100% premium relative to emerging markets on forward price to earnings ratios, which compares to its post 2020 average of about 70 to 75%. The extent of overvaluation also has gotten a bit stretched at this point in time. So I'd say that's the main risk investors looking to put money into India should be aware of, even though, like I mentioned, history does suggest that overvaluation is not always a necessary condition for India to underperform. That being said, from a global markets perspective, from a global asset allocation perspective, we are overweight emerging markets from a 1 to 3 month perspective, and we are underweight emerging markets from a 6 to 12 month perspective. So within that, I think we're looking at a neutral weight on India at this point in time, because we're looking at those rich valuations, but we're also seeing that earnings performance has been pretty exemplary in India relative to the rest of the emerging market pack. If you look at emerging markets, they've done about a 0 to 2% earnings expansion this year, 2024 YTD, while India has done something like an 8 to 10%. So I'd say that's how we're looking at India at this point in time. We'd allocate a neutral weight to it within a larger emerging market portfolio. The values are worrying, but they aren't worrying enough to warrant an underweight to the extent that there seems to be reasonable follow through in terms of earnings and growth performance.
Despite global uncertainties, the Indian economy has shown resilience. What are the key drivers of this growth? And are there any short-term or long-term risk that could impact the Indian economy?
Right. So I think a couple of things have worked in India's favor over the last 2 years. I think number one, while growth in India slowed, growth in other large emerging markets like China slowed more. So from a relative perspective, India came out looking stronger, even though it did see its growth metrics come under a degree of pressure. So I think that's one point that really helped India in attracting a lot of flows, emerging market flows. Number two, I think what's well known about India is that it doesn't rely on exports or the global manufacturing cycle as much as, say, a China does. And that again worked out in India's favor because you had that initial surge post pandemic in terms of demand for manufacturing goods. But that surge quickly faded, and then demand for services went up. And in that environment, obviously, anybody who relied on the manufacturing cycle more stood at a disadvantage. And that's a dynamic that worked out in India's favor. And I think the third reason why India has been able to sustain such rich valuations has to do with the fact that China fell out of favor when it came to emerging market investing. And so, there were a certain amount of funds that had to be allocated to emerging markets. And since a lot of investors were not feeling comfortable allocating it to China, that money just ended up with India, Korea, and Taiwan. So I'd say those are the factors that have worked in India's favor of late. What are the big risks with respect to India? I think one is, of course, valuations. And this is a pretty well understood risk. I don't think I'm saying something new here. It's a very well appreciated risk whenever anybody is today putting money into India. But I think one underappreciated risk that I'm quite cognizant of when it comes to India is that India, Mr. Kim, just doesn't have that many listed companies of scale. Let me illustrate that point to you with an example. So India is a $3 trillion economy. And the largest consumer staples company in India is a stock called Hindustan Unilever. Hindustan Unilever does annual revenues of just about $10 billion, or maybe even lesser than that. Then if you look at something like France, which also has a $3 trillion GDP, and if you look at the largest consumer staples company there, it's probably a L'Oreal, and a L'Oreal potentially does nearly 5 times the revenue that a Hindustan Unilever does. This is something I've noticed in the past with respect to India, that while it has a lot of themes going for itself, it has a democratic head of state, which has it's a very sustainable and trustable institution. It has a demographic dividend going for itself, which again works in its favor against the backdrop of so many countries aging far faster than we'd expected. But not all of that translates into large companies, large listed companies that can capitalize on those themes. And I think that's something, hopefully over a period of time gets addressed. And there's a whole generation of large companies that emerge out of India.
Great answer. How might the recent geopolitical tensions, such as China-India border conflict or US-China conflict, impact the Indian market and economy?
Right. I think what we've figured out in the Indian context is that as long as geopolitical issues do not translate into immediate term impacts in terms of earnings growth, these issues get flagged, discussed, but don't end up having that much of an impact in terms of market movements. I think the bigger market movements that affect India are anything to do with the Middle East, to the extent that conflagrations in the Middle East end up causing oil prices to move up. And oil as a commodity is something that India is a net importer of. And in my experience, I think anything to do with geopolitics and the Middle East tends to have a market impact in India, as compared to things around India and China having skirmishes around its borders, or India and Pakistan having disagreements around border issues.
If you had to choose between the Chinese and Indian stock market to invest in now, Which would you choose and why?
Right. So that's a $1 million question, or perhaps even $1 billion question. And let's think of it. Let's think it through. So India, like we were discussing earlier, a richly valued emerging market trading at about 24 times forward price to earnings. China, a relatively cheap emerging market trading at about 9 to 10 times forward earnings. India, a market that has delivered quite solidly when it comes to earnings growth. So I think if you look at early 2023 forward earnings for MSCI India and where things are today, there's been about a 25 to 30% expansion in earnings. If you look at China along the same time period, earnings have been largely flat. So those are the two emerging markets that you're dealing with at this point in time. In the near term, like I was mentioning to you, we are overweight emerging markets. We do think that it is possible, emerging markets as a whole are so cheap, and it is possible that the manufacturing cycle holds up for a bit. The most recent data hasn't been great, but the prints before that were all right. So the combination of cheap valuations and maybe the manufacturing cycle holding up for a bit longer, and the dollar is depreciating at the end of the day, all of that could cause emerging markets to do well in the near term. But from a 6 to 12-month perspective, once the recession arrives, the emerging markets will do badly, especially something like a China, which is so dependent on the global manufacturing cycle. So I'd say from a 1 to 3 month perspective, we are overweight emerging markets. I do think China has a chance of doing well in the short term. From a 6 to 12-month perspective, once the recession arrives, we'd be underweight on emerging markets. And within the emerging market space, we expect China to perform while India to operate in a neutral territory. So that's how we play things from a tactical and a slightly longer term time horizon.
Thanks so much for sharing your insight. That was my last question. And this was very informative discussions. I really appreciate your time and expertise and looking forward to staying in touch.
Absolutely, Mr. Kim. Some great questions there, and glad we could spare time for this chat. The pleasure was entirely mine.